Greetings. Keith Prather here with the NCM Automotive Demand Index report for this month. Let me share my screen over here real fast. So interesting times right now, obviously. The Automotive Demand Index up through March, which is the latest data that we have available, showed kind of interesting. It was a little bit lower month over month and a little bit lower year over year, actually 6.5% lower year over year. And remember that this is a demand index, so it's looking forward. And even though we had good automotive sales, in March, and we'll show that to you here in just a moment, it's showing that weakness that we would expect kind of coming up over the next two quarters. And again, a lot of this and almost all of it's going to be driven by tariff risk and a little bit of what's happening with the Department of Government Efficiency and some of the layoffs that's happening at the DOGE level. But generally, there's just an economic malaise, if you will. Just a lot of executives being really conservative in the way they want to spend money and invest it. And a lot of that is kind of spilling over into the private sector. Just the concern over tariffs and what's happening with risk of inflation, a little bit of a risk of long-term shortages of some products, especially as we get into the end of the year, and just not a lot of progress on the trade front. At the time we were recording this, kind of midweek, it looks like there could be some trade deals in the offing, right? So some negotiations have been happening obviously behind the scenes, and it looks like there could be a deal or two ready to be announced either sometime this week or early next week. And that could dramatically change things. That could dramatically change the environment and the way people are looking at least the second half of the year. And we do think that it will pick up, and we do think it'll overall um, help the automotive industry a little bit, at least from the consumer perspective. So sales, again, as we said, sales were actually very good. So we had good, strong sales, almost 17, well over 17 million units surging in March. They were 11% higher year over year, or I'm sorry, month over month, and 14.8% higher year over year. Inventories, though, also are still 35.7% lower against pre-pandemic levels, and they're 16% lower year over year. And so you can see from an inventory perspective, I know a lot of dealers are really feeling like they're sitting a little bit heavier than they probably should be. But at a macro level, when we look across the entire country, we still see inventories sitting a lot lower than they were prior to the pandemic. And a lot of us have been having conversations about whether this is the new normal. Should we expect this to be kind of where a lot of dealers would like to keep their inventories? We learned a little bit about using the showroom literally as a showroom and then ordering vehicles and bringing them in. So we're not carrying a lot of dealer inventory. There could be a little bit of that at play here. But the bottom line is that if we do continue to see a pretty decent sales cycle on vehicles, that it would continue to deplete inventories, and then the OEMs would be in a pretty good production zone and would be ready to crank out a lot of new product. That's one possibility. The other possibility is that the OEMs kind of hold because of the tariff risk, and they don't want to pay 145% tariffs on certain products, and then we see the inventory to sales ratio continue to dive. We know used car vehicles, we know that that inventory continues to shrink and contract as a lot of people jump out and try to pick up some good quality used cars. We also know that coming off of the leasing trends that we had during the pandemic, that we have fewer good, high quality lease or program cars coming back on the market. And that affects us a little bit as we kind of look forward with used car inventories. But overall, just the market is just sending us so many mixed signals. But as we showed you kind of early on, the forecast ahead looks like it could be softening a little bit from a demand perspective. So when we modeled the current perspective, and we had this across a lot of the videos this month, we looked at the impact of tariffs. So this was before the April 2nd reciprocal tariffs, and this is retail spending in general. So this would account for about 70% of the US economy. And you can still see the retail spending is expected to be pretty good. Now, after April 2nd, what we got was just a little bit of deceleration, but there was nothing here that looks recessionary. So we don't get that recessionary pressure signal that you would expect, maybe given all of the fantastic headlines that we see in the press. Retail sales, advanced retail sales in March and through early April were still pretty good. We were seeing retail growing at almost 5%. So we don't see the consumer really pulling back a lot, even though we're hearing, especially at the corporate level, we're starting to hear a lot of executives talk about, as I said earlier on, kind of pulling back spending and investment We just don't see that materializing yet across the market. And again, these forecasts have a high degree of accuracy, so we're pretty confident in them. And right now, it's just not showing, even with the heavy reciprocal tariffs in place, a dramatic pullback like a lot of the fear and trepidation is kind of telling us. So we may be a little more optimistic than most folks, but we're just staring at the data and kind of going with what the data is telling us. So automotive production forecast, though, is fairly flat. Tariff pressures are showing up on the production side of things. And we do see it kind of flattening out with maybe a little bit of a dip early next year. But again, not recessionary. We don't see a full pullback by the OEMs. We don't see that production really, cutting back to zero, or don't see it going into what we would normally get as a recessionary cycle like we saw in two previous periods. We're just still getting a flat curve here, which is still good. I mean, it means that you're going to still see some good average sales. May not feel as good as last year, but to a degree, if they flatten out from here, I don't know, you could see sales that are a little better than expected. So the Federal Reserve, real important, I think, across all the sectors for NCM this month. Federal Reserve looks like they may be ready to step in by June. There's a couple things fighting against that. Most models are kind of showing now maybe 3/4 point cuts between now and the end of 2025. A lot of that would be because headline GDP, headline growth is slowing. And so we would look for that. Some inflation risk is on the horizon. So we do know that Q1, when we got the Q1 data, when we look at consolidated inflation across all sectors of the economy, it was about 3.7% higher than the Fed's target rate of 2%. So that's a bit of a concern, and that might be the one thing that holds the Fed up is if they see economic growth slowing but not tanking, but they see inflation rising, that would be their formula for probably having to hold on rates. Otherwise, what we think we'll see if inflation stays fairly tame and we see energy prices coming down and we see some things that could help kind of tame inflation. We see a little bit of pullback in spending. We see a little bit of sluggishness in some consumer pockets. If that continues, then you're in for 3/4 point cuts in 2025, which would be phenomenal for helping out automotive spending. The 10-year Treasury, which is critical for long-term borrowing, the way we think about it in automotive is that um, as consumers go out and they start to refinance their current and existing homes, their mortgage rates come down enough that they're able to go in and do some big ticket buying like automotive. And so we're hoping, and what the Treasury Department believes, that they're going to be able to get that 10-year Treasury rate down below 4% by sometime this summer. And if they do that, that would trigger a bunch of refinancing, and that would then lead to more automotive spending. Job market right now, there's a little bit of uncertainty in it. You can see a little bit of fear and trepidation among consumers, but right now it's stable. We still have an unemployment rate that's fairly low historically. We've got about 7.4 million jobs open. Normal is about 6. So we've got a pretty good environment. Wages are still growing at about 3.8%. Um, Normal or average would be around 2.5%. So you still got good wage growth. We've still got steady unemployment. It's not rising at a significant rate. We've got a lot of jobs open. And so job market's still pretty stable. And then we'll see. We think that a wave of trade deals that come out in July are actually going to help. On top of that, you could also get a new tax bill that gets signed. And inside that is a bunch of corporate tax incentives, especially for industrial projects, a lot of depreciation bills that will help with making those projects palatable, if you will. And so with that in mind, it looks like we could get a very different and a very good second half of the year. And that's what most analysts are thinking about. So for Q1, we came in down about 0.3% over the next 2 to 3 months. We'll get adjustments to that. We think it adjusts maybe closer to zero, so it's almost a flat quarter. In Q2, forecast right now is somewhere between 0.5% and 1%, but still some moderate growth. And then we get acceleration in the second half of the year, and you see a little better environment. Not as good as we had last year, but still decent enough that it's going to be okay. We see for the full year then growth of maybe 1.5%. a lot of this depends on trade and depends on tariffs and it depends on, how we end up settling a lot of these trade negotiations. And the way some of those deals could go, we could open up a lot more U.S. exports, especially agricultural products, automotive, and a couple other sectors that could see some real positive growth, especially energy. And if that happens, then GDP will come in a lot hotter than 1.5%. It'll come in, way north of that. We could be looking at 2.5%. So here's hoping. There's still a lot of moving parts and a lot of risk out there still, but we're going to stay optimistic for now. And again, this is all just developing and moving as we're speaking. By the time I get done with these videos, conditions could change again. So we'll see what happens. But for now, hope you have a great month and we'll see you next month. Okay. Take care. Bye bye.